Welcome, everyone. Welcome back to Venture Wisdom, a place where we talk all things venture capital and private equity. Today, we are here uh, because of a buzzword that we have been hearing lately, and the buzzword is RIA. And it has come up because we have heard quite many big name VCs of late becoming a RIA. What is RIA? I'll probably not get into the details, but RIA is Registered Investment Advisor. And the most recent name which took that route is Lightspeed, other than the bigger ones like A16Z, General Catalyst, Battery, and many others. Um, we will be unwrapping what RIA means. We will be talking about, is it a right route for all VCs or is it not? And why certain VCs are taking that route. To take that discussion today, we have with us Yoni Tuchman. We all have heard him in past. If you have not, I suggest that you go back to some of the other Venture Wisdom episodes and listen to Yoni. Follow him. He has a lot of other things that he keeps sharing on his social profiles. He's a partner with DLA Piper's fund practice based out of LA. Also joining us, we have Jessica McKinney. Jessica is an associate with the fund practice at DLA Piper, and she's based out of Miami. So thank you so much, both of you. Really appreciate your time today and to help me unwrap this whole buzzword of RIA versus venture capital today.
Thank you. Thank you for having us, Rakesh. If it's going to be as much fun as the last few, this is going to be a blast. We're excited to
I
do it
have
with you.
no doubt about that.
Yes, thanks for having us.
We heard few of the VCs, particularly the big names who have been now managing a couple of $1 billion going the RIA route. And then we have been seeing all over the net, particularly LinkedIn and Twitter, that RIA is the future of venture capital. Would love to hear in a very layman terms, what is RIA? Why certain VCs are going that route, and what it means to be an RIA versus an exempt.
Great series of questions. Can I not bury the lead? I just want to start by saying, and Jessica can share her perspective and overrule me. RIA is not the future of venture. Okay, so everyone who's listening who manages venture funds and SPVs, and they're thinking, oh no, Lightspeed registered as an RIA, and all these others registered as a registered investment advisor. What does that mean for me? The answer is it means nothing for you. You're good where you are. And what we're going to talk about over the next few minutes together is why a firm may choose to register, right? Why would they register? What's in it for them, right? What are the costs involved? What's the analysis that they undertake, the pros and the cons, the costs and the benefits of then choosing to register? And then you'll be equipped and empowered to do the same cost benefit for yourself while you listen or after you finish listening to this conversation, and then you will know whether the future for your firm is to register or not. But I'm gonna guess that the answer is no, it's not. Let me start with a small story, if I may, which is really by way of introducing Jessica in another way. I was once talking to a different law firm years and years ago that does fund formation, and the lawyer there who does the fund formation, when I asked him who is in charge for your clients, for your fund clients, the regulatory aspects of their fund, he puffed up his chest. He was very proud, and he said, "Me," because the regulatory is so important for my clients that I need to be on top of it. I thought it was an interesting perspective. I have the opposite perspective, but for the same reason, ironically. We have the same rationale, but we come to opposite conclusions. I agree with him that the regulatory aspects of your firm, of your clients' firms, is so important. That's why I don't want it running through me. I want there to be someone on the team whose sole expertise and knowledge keeping up with every new sneeze that comes out of the SEC, they know about it, right? And so that's why I'm so excited to have Jessica on with us, because Jessica is one of the folks here at DLA that whenever we have a new fund a new firm, a new client that's raising something, I don't say, okay, let me tell you all about the structure and the tax and the economics and the market terms, and let me also handle all your regulatory. I say no. Meet Jessica. She's the one who's going to be in charge. She's the sheriff when it comes to all things regulatory. And when I say regulatory, 90% of what I mean is the Investment Advisors Act. Should you
Mhm.
register? Do you have to register? If not, what are your exemptions and how do you comply with the Advisors Act? So that's my little kind of intro to Jessica. But maybe we could start back and I maybe even say, Jessica, even before Rakesh, we ask like, is the future of venture registering or not? Let's just peel back the onion a minute and just say, what is an investment advisor? Like, are you an investment
Mhm.
advisor? Like, before we talk to whether you need to register as such, what is it?
Right.
Jessica, let's talk about what is an investment advisor.
Yeah, and I think one of my goals today as well would be to break down some of the jargon. We started talking about RIAs, you're going to hear about ERAs, we're going to talk about RAUM. What does all of this mean and how does it apply to your business? So hopefully taking something relatively complex and shedding some light on it and making it digestible for your business. So I think, taking a step back, like you said, Yoni, what is an investment advisor? Does this apply to me? Should I even be thinking about it? The answer is yes, you should be thinking about it. Investment advisors, very broadly defined by the commission in most states to mean really any individual or firm that is engaged in the business of providing investment advice with respect to securities for compensation. Very broad, can get very nuanced, but keeping it, high level, what does that mean for the general partner or the manager of a venture capital fund? That means that you're likely going to fall within this definition of investment advisor. So what
Right.
does that
Because,
mean? Yeah, go
yeah,
ahead. Yuni.
no, I agreed. And I'll just double click on it as we go. I mean, think of the three prongs that Jessica just mentioned. So for compensation, now everyone listening to this who runs a venture firm, they're not doing it altruistically, right? You're doing this for compensation. What are your compensation? You're probably getting management fees. You're probably earning a carried interest. Those are two forms of very substantial, hopefully, eventually compensation that you're getting, right? And why are you getting those compensation? Because you're holding yourself out as a business of advising funds as to the purchase and sale of portfolio company securities. So, like as
Mhm.
Jessica laid out, like you are the textbook investment advisor. Like there's no wiggle room around that. Can I just share you where there's wiggle room? And I don't know, Rakesh, if you have like real estate advisors listen to this, but if you were to manage a real estate firm or
Mhm.
a fund, a firm, an investment firm that invests in real estate, then this question will be very different. Or I rather, the answer to this question will be very different because you wouldn't be you have compensation, right? You're getting the same management fees and carried interest as a VC is getting for managing its funds. You're holding yourself out as doing this business, but are you advising with respect to securities? And
We could
arguably
have
you're
another.
not, right? Because what are the funds doing that you're advising? They're investing in buildings, in brick and mortar and dirt, right? Those are not securities. But because the portfolio companies that VC funds invest in, and I would add that PE funds invest in, those are securities. That's how you get that third prong satisfied of the definition of investment advisor. Um, and that's why, as Jessica says, that's why the answer is sorry, you are an investment advisor.
Fundamentally, what we say is every VC, every private equity, securities side, and those who are doing the infrastructure, real estate. I don't know if crypto is still treated as securities or not, but they are doing cryptos as well. Everybody is an investment advisor. Now the question is, which one really needs to go to be registered versus staying an exempt?
And I
So if
think,
you're investing in real estate only, then arguably you're not even an investment advisor. You don't even fall within the definition. There's nothing to ask, do you need to register or not? Because you're not an advisor to begin with, because you're not talking about securities, you're investing in real estate, which is not securities. But anything security related, anything company related, or even, I would even say crypto related, now
Mhm.
you're in the world of securities Now you are in the world of investment advisor regulation, and now you have to ask yourself, must I register or not?
But here, I have a quick question here. While I understand the difference between the brick and mortar versus securities, but was it not always about different asset classes? And real estate still remains to be an asset class. And you have a pool of money of investors that you are helping investing in real estate, which is an asset class. Security, not security, I understand, but it's still something that you are investing for a pool of investors in a different kind of asset class. So why is that not considered to be part of being an advisor?
And that's, let that be the first misnomer that we want to clarify and very clearly underscore. The notion of investment advisor regulation is not about advising funds with respect to investing in an asset class. It's about advising funds in relation to investing in securities asset class.
Okay.
So anything that's
I
a
think
security.
that's an important part of it.
That's
it's
super
asset
vital.
class versus securities itself.
That's right. That's
Right.
right. So a debt fund that's loaning, those are going to be securities most of the time. And there's going to be gray. And that's why someone like Jessica needs to be on speed dial, right? Because there's a lot of nuance. There's a lot. Is this a security or is not a security?
We can
It's
have an
not
entire
always clear.
podcast discussing securities.
And everyone would fall asleep in the first 10 minutes of what a security is, right? But one thing to be clear is real estate is not, right? And I don't want to dwell on real estate because I don't think that's the primary, participant in this podcast or listener, but that's just one thing to keep in mind. Like if you're truly not investing in securities, then there's nothing to talk about. You're not an investment advisor. Go listen to another podcast. But if you're investing your funds into a security of any type, whether it's a digital asset security, a startup security, a growth equity security, a buyout security, investing in a company, that's going to bring you that's going to bring you within the rubric of
So the
an
good news
investment
is that
advisor.
our audience is all VC and private equity, and they are all doing listed, unlisted securities or sometimes debts.
Right.
Right. So then you're an investment advisor.
Right. So then I think that's a good segue into talking about the sort of how do you determine your registration and compliance requirements. And in that case, you're looking at your size, the size of the advisor, and then we're getting into the investment activities and the investment strategies to determine, okay, I'm an investment advisor, subject to registration. Is there an exemption available? And if so, what are they? And we can talk a little bit more detail about which set of rules am I even looking to. There's state rules, there's federal rules, what preempts state law. It can get nuanced.
Right, but we're gonna keep it simple. Jessica's right. It can get very nuanced. But let's think like this. Okay, I'm raising a VC firm. I'm raising my first VC fund, right? I'm raising $50 million, okay, to invest in startups. How would you approach that? We already clarified that you are an investment advisor,
right?
By definition.
So you're an investment advisor. Are you subject to state law? Are you subject to federal law? And that's going to be driven by the size of the advisor, not necessarily the investment activities. So we're looking at several key dollar thresholds at this point. If you're below 25 million, you are subject to state law. If you're above 100 million, you are subject to federal or SEC rule and regulation. So we have it split between state and federal. But then with any rules and regulations, it can get a little gray and there's some exclusions. And there's this category of advisor often referred to as a mid-size advisor where you're between 25 million and 100 million.
Which would be a lot, no? Wouldn't that be a lot of advisors? That's a big gap between 25 and 100. Okay.
Absolutely.
So less than 25, there's nothing to talk about. SEC won't even talk to you. If you're
looking at your state,
you're just in the state where you operate, your main state where you live, right? So, and when we say these 25, so here's the numbers, right? 25 million, 100 million, and then we're going to talk about, I think, 150 million in a few minutes, right? When we talk about these numbers, we're talking not about the size of a particular fund or particular vehicle. We're talking
Mm-hmm.
about all of the assets that are managed by your management company, okay, across all your funds. Right, that's right. If you have 4 funds, each of which has $25 million, then your assets under management is 100 million. We look at all the things that are paying you fees or carry, not just one in particular. You just put them all together, and that's the number that Jessica's talking about, 25 million. So less than 25 million, don't even look at the SEC. They won't talk to you. Very snobbish sometimes. You're dealing with with the local state regulators. Over 100 million, you're only talking to the state.
To the
Jessica,
SEC.
I'm sorry for the SEC. And then how we deal with all of our clients are like raising their first $50 million fund between 25 and 100.
So this is going to be driven by the state where they're located. So again, you're looking at your state law. Often there's an exemption available at the state level. And depending on how advisors are regulated in your state, if they're not regulated, you might be subject to SEC registration once you cross the 25 million threshold. And then you'd be looking at exemptions available at the federal level, which we'll talk about in a little bit more detail.
Okay, so basically, am I right to say anything less than 100 million of assets under management, you're first looking to the state. If you're less than 25 million, you only look to the state. There's nothing to talk about with the SEC. But if you're over 25, but under 100, the order of operations is look to the state regulators. If they regulate you, you stay with them. If they don't regulate you, then you have to look to the SEC because someone needs to regulate you.
That's right. And then we'll
Okay.
talk about some exemptions at the federal level that may not necessarily preempt state law. So during that mid-size advisor category, you may be subject to regulation or relying on exemptions at the state and the federal level. And again, this can get nuanced depending on the state you're in. I don't think we need to.
Yeah, 50 state survey right here. Jessica knows this side. She'll just roll it off her tongue. 50 state survey.
So a quick clarification here.
It's just,
When you say state, do you mean the state where the manager is incorporated, or is the state where they operate?
the state where they're operating, where they're making investment decisions.
Okay.
That's a
So
good
even
question.
if I'm a Delaware incorporated and work out of Florida or California, I'm
Correct.
governed by Florida or California.
Exactly. That's a great question. Right.
Okay,
And I
so-
think the key takeaway is to keep state regulation in mind until you cross the 100 million threshold.
So Rakesh, so you're forming your first fund, this $50 million target. So first you look, and we said you're over 25 million, assuming you hit, somewhere near your target. So you're over 25 million. So but you're less than 100 total assets under management. You look to the state where you live, where you're making your decisions, your investment decisions, whether it's New York, California, wherever it is, any other state, Florida. And then if the state regulates you, you deal with the state filings and exemptions. If the state doesn't, then you look to the SEC. Okay, so now Jessica, now we got our bearings. Let's say the state doesn't regulate you, and we're talking about the SEC. Okay. So we are an investment advisor that we clarified. We have AUM, assets under management, where we're looking at the SEC's rules. So why don't we have to register now? We are an investment advisor regulated by the SEC. Go ahead and be an RIA. Why not?
That's an option. There are also exempt options that are available depending for many private fund advisors. Again, we're looking at size, and now we're also looking at your investment activities and your investment strategies, which I think we're talking about towards the beginning. That comes into play with respect to these exemptions.
Right. So let's break down I think this is where a lot of the meat is going to be for a lot of the listeners here. You're an investment advisor and you're over 25 million. So you're looking at the SEC either because the state doesn't regulate you or because you want to be talking with SEC. Let's talk about whether registration is good first a second. I don't know. Is registration good or bad? I know that's kind of what Rakesh opened with. We're going to talk about how you can avoid registering, even though you are an investment advisor with enough AUM to register. We're going to talk about how you can avoid that. Do you want to avoid it?
Why at all do you have to register? When
Well,
exempt is a very obvious route, you have a lesser compliance, you have a lesser overhead, you are too small as a function, a 5 people team or a 4 people team managing that $50 million. Why do you have to go register and add that overhead to yourself?
totally agree. That's my perspective also. And I would answer this like that. I would answer that like this. You would only register when you don't have an exemption anymore. If you
Mm-hmm.
have an exemption, use it. But you may lose your exemption and you may choose to lose your exemption because it could be that the exemption is hamstringing you because you have to fit
Sure.
within a box to avail yourself of the exemption. And you
So
may
there are
decide, yeah,
so there are two parts that are here. One, you have to lose the exemption because of the framework. Second, you choose to give away the exemption and register. So what are those two scenarios? Let's understand that.
let's talk about the different exemptions and we're going to see how you may
That'll,
lose them and how you may choose to forfeit them. Let's talk about three exemptions. The main one,
yeah.
I think, for this audience is the VC advisor exemption. This is a special exemption that just applies to venture capital firms. All right. Let's talk about what that exemption means. And then why would a venture capital firm that has that exemption choose to abandon it and to register as an RIA? Let's talk about that. Before we talk about that, I want to just set the table. The second exemption that we should talk about is for managers that may not be VC exclusively. Maybe they're PE, maybe they're credit, but they have less than that third tier of AUM, 150 million, and they only advise private funds. If you manage less than 150 million across all of your business and all of your clients are private investment funds, then you have an exemption. Now that one's easy because when will you lose that? When you keep growing. You grow out of that. It's like I bought my son a suit. 6 months later, it's like way too small on him. You have a $150 million, exemption. Now, unless you're content keeping your business at that size until the end of days, great. But most clients and most firms are not content with that. We're aspirational. We want to grow. When you grow past 150 million, that exemption falls away. So that's
But
the easy one.
isn't there another reason here? So I understand the size, and I don't want to jump the gun here, but it's also about the type of security. So if I am not just doing the unlisted equity, and as a VC fund, I have about 20% leverage to invest in the public securities, and I want to do more of the public securities. Does that play a role as well? I don't want to jump a gun. It may be there on your list to speak about, but that's one thing
That
beyond the size that I believe is another reason to go that route.
totally agree. And you're ahead of me. You're too quick for me. So, but I agree with everything you're saying, Rakesh. I was just setting up that the exemption that doesn't depend on what you're doing with your money, like how you're investing it. It merely depends on the size
Okay.
that you'll just graduate out of. But you're totally right. The other exemption, the one that is not size dependent, it's activity dependent. It applies to your status as a venture firm. If you stay within the contours of how the SEC defines a venture advisor, you can grow your firm to $100 trillion big, okay? And you still are exempt. You never graduate out of it because of size. But here's what we're going to talk about now, the question you just asked. How does the SEC define a venture capital firm such that if I stay within that box, within that definition, I never grow out of it, no matter how big I get? And maybe staying within that box alone is too suffocating for me. So I'll choose to break out of that box to register so that I don't need to fit within the more narrow contours of what the SEC says a venture capital firm is in order for me to keep that exemption that only applies to VC firms. Okay? So that's exactly right. And that's what a lot of these firms have done that you
Mhm.
that you started off like, we're venture firms. We have way more than 150 million of AUM, but we still don't have to register because we have the VC advisor exemption, and you never outgrow that. But then they pivot in their business strategy and they say, I want to do more stuff than the SEC allows a VC firm to do. And then I have a choice to make. Do I want to keep the ease and convenience of the exemption from having to register, but at the same time live within those narrower contours that will prevent me from doing types of businesses that I might otherwise want? Or do you say, no, I'd rather accept the burden of registration, the cost and the headache that that involves, because the benefit of that outweighs that cost. What's the benefit? It's going to unshackle me to then make the types of investments, more types of investments that I couldn't do and still live within the VC exemption. Okay.
So from here, steering back to the point of those two point fork, where you either choose to give away the exempt status and register, or you lose to avail the exempt and get to the RIA route. And would love to hear what Jessica, because I know Jessica started from the size to the activity-based definition of that or the bifurcation that happens with that. So Jessica, what do you have to say on that?
Want to start by breaking down another sort of buzzword. We're talking about RIAs, and now the two exemptions Yoni described, the VC exemption and the private fund advisor exemption, are often referred to as ERAs, exempt reporting advisors. And those are the two categories. So the venture capital exemption is when it gets into your investment activities and how that drives whether or not you're required to be registered. So at the highest of level, a qualifying venture capital fund is making direct equity investments in operating companies. Outside of that, there's a 20% bucket if you're looking to, purchase in the secondaries market. If you're looking to invest in other funds, you have to keep it within this 20% bucket or you blow your exemption. And this is on a fund by fund basis. So each fund has to qualify as a venture capital fund within this definition, which is pretty narrow. And then there's also just a few other limitations on the use of leverage and some redemption rights to keep in mind as well. But I think this is also this definition of venture capital, sort of from a policy perspective. Is this the right time for Congress and the SEC to rethink this definition? Has it caught up? Has the market? Are you able to pursue a venture strategy and still invest in secondaries in some sort of limited way? Still some way to invest in fund of funds in different geographic locations and still pursue a venture strategy? Is this, I think it's right for Congress and the SEC to maybe reconsider some of these limitations. But until that time happens, we're stuck with the rule as it's drafted.
And maybe we'll lobby Congress a bit to reflect on its SEC's definition of what a venture capital. Let's break down. Some people have it clearly. I think there are 5 prongs. I think for what a VC. So the VC exemption says that if your manco is doing nothing but advising VC funds, then you never outgrow your exemption. Okay. That's like the bottom line. Like you only can advise VC funds. Now, okay, what is a VC fund? Is a one-off syndication on AngelList or Sidecar or Carta a VC, just investing in one company? Is that a venture fund? So that's these defined venture funds, and it has 5 things, right? I think if I'm getting this right, Jessica, like what are the prongs of a venture fund? And then you have to fit within all 5 of these in order to keep every vehicle you raise needs to satisfy every one of these 5 prongs in order to never outgrow this VC fund advisor exemption. And then if you want to be able to go outside in any of your vehicles, any of these 5 prongs, that's when you're looking to shed the benefit of the exemption and to elect in to registration. So let's just break down really quickly, very high level, what these 5 prongs are. And one of them is what we started talking about, this this 20% bucket in qualifying investments. That's one of the 5 prongs. I don't want to lose. It's probably the most important one, but let's just run through the 5.
Yeah. So maybe I've combined one into.
Okay, maybe I'm wrong. Maybe
Right,
it's
so
4.
I've
Maybe
got
it's 6.
4. But we have, right. So your first, so your fund needs to represent to investors you're pursuing a venture capital strategy. You need to generally, there's limits on redemption rights, which with any
Can
closed-end
I pause there
fund.
for half a second? I'm sorry, I just want to pause there. When we raise venture funds, we literally say in the marketing documents, this fund is pursuing a venture strategy. Rakesh, I don't know if you've seen that in like PPMs or some of your terms. We literally say that. Isn't that an odd
Yeah.
thing? Like the reason we say it is because what Jessica just said, the first prong, no matter how you count them, we both agree this is one of the prongs. You have to hold yourself out to the public, to your investors, as pursuing a venture strategy. Now, isn't the best way to do that to just say it? That's why we say it, right? I want to focus on that. If you've seen that in marketing docs, this is why it's there. Continue. Sorry, I started to interrupt.
No, definitely. Just keep the conversation going. The second prong, with any closed-end fund, there's going to be limits on redemption rights. You're going to have limited liquidity for your investors, so not necessarily one of the more controversial prongs for venture capital funds. The third, you're going to have, this is where we talk about the qualifying investments and the non-qualifying basket. So you need to hold no more than 20% of the fund's aggregate capital contributions and uncalled commitments in non-qualifying investments. So that's your 20% basket to have secondaries, fund of funds, anything that's outside of the qualifying investment, which, like I said, is generally a direct equity investment in an operating company. So you have a very small bucket, depending on how much capital you've raised, to facilitate some of those non-qualifying investments. And then you also need to have, there's also some limitations on the way you're able to use leverage and repay it, which often impacts subscription lines. Most common with venture capital funds, that's usually where the limits on leverage come into play.
Right.
But
Which
at
is
a high
often
level,
easy.
that's a venture capital fund.
Right. So you have like a 15% debt leverage limitation in a venture fund, which is easy to satisfy because venture funds are not borrowing to make investments. They may be just bridging capital calls a bit, but that's usually
Right.
easy to satisfy. And then what I think the last one is that you're not registered. It's that you can't be like a 40 Act fund or something like that. But maybe that's like a throwaway.
Right. So with any, it's a private fund. So when we talk about as an exempt reporting advisor, a venture capital fund or a private fund gets into which investment you're excluded from the Investment Company Act.
Right.
Usually based on, 3C1, which is less than 100
Right.
investors, or 3C7, which is limited to qualified purchasers. So as a
Right.
baseline for either ERA, you have to only advise private funds. Correct. Yeah.
Of all, as you heard, Rakesh, those are all easy to satisfy. You're not a hedge fund. You're not giving your investors liquidity rights, right? It's a closed-end vehicle. You can't just get out because the month is up or the quarter is up. You hold yourself out as a venture firm. You limit your amount of indebtedness. You're a private fund, right? You're not a registered entity. Those 4 are super easy. The 5th one is the one where you ran to, Rakesh, appropriately, correctly, and where Jessica was digging into as well. Would it be helpful to focus on that a bit? Where could people get tripped up? And this is the one that causes VC funds to want to voluntarily shed their exemption, which otherwise they would never have outgrown, but they'll shed it intentionally in order to register. Why? They could live with the debt limits. They could live with holding themselves as a VC firm. They could live with not giving their investors redemption rights. They could live with, and they will live with, not being a registered 40 Act company. But it's this 20%, 80% dichotomy within every vehicle where you
Yeah, that's
cannot
exactly I
invest.
was coming to next, because this conversation is naturally leading to why you really choose to become an RIA,
Right.
right? Whether it's different kind of securities, whether it's a closed-ended versus a rolling fund versus another type of fund. Because I don't remember A16Z when they chose to become an RIA, it was because they were forming the crypto fund, right?
Mm-hmm.
I know a couple of other guys who chose to abandon exempt and become an RIA because they now wanted to get into the secondaries largely over the primary investment. So yeah, so I think this conversation is naturally leading to the point why somebody would choose to abandon exemptions. and take the RIA route?
I'd say in my experience recently, the overwhelming majority are coming to us because there's a secondaries opportunity and they want to create some sort of SPV to take advantage of the secondaries opportunity. And they're having to weigh the cost benefit of registration and then also the timing consideration. You need to be fully registered before you're able to take advantage of that opportunity, that non-qualifying venture capital fund opportunity. So it's something to sort of think ahead about if you think you might want to, or there might be secondaries opportunities and you're prepared to register, you need to have that registration effective before you're able to pursue a non-venture strategy.
So
It's
is
helpful
it
for
safe to
planning.
say in this case that sometimes, while okay, it's a choice right now that we are talking about,
Mm-hmm.
but sometimes it's also a matter of market dynamics. So
Mm-hmm.
the very illiquid nature of the venture strategy and the limitation in the exits and acquisitions that have happened in the market in last couple of years, which will only grow as we see because there's so much money
Mm-hmm.
floating in the primary investments, will naturally lead to more and more funds coming with the secondary strategy. So it's the market dynamic also which is driving that approach towards RIA versus the venture strategy. Is that a safe point to say?
That could be. I know I'm stupid when it comes to economics, like macroeconomics. But if it's true that because of the dynamics in the market, there are more opportunities, more rich opportunities in private secondaries, then I agree with
Mm-hmm.
you. Then there's more reason why VCs who are so close to these companies who want to take advantage of those opportunities may say, look, I don't want to stuff all these great opportunities limited within 20% of any vehicle. I want to have a dedicated vehicle, whether it's an SPV or a fund that's going to
Mm-hmm.
invest in a lot, a
So that's a
lot.
natural shift that is happening, and the numbers speak
Yeah.
about it in the market itself. Yoni, since you brought that up, the liquidity has always been a problem. More and more
Mm-hmm.
companies are choosing to stay private over going public.
Exactly. Mm-hmm.
The investors, they need liquidity. The funds have a definite sunset. How do you make an exit, right? And that's where the secondaries are on the rise now.
There
Right.
you
And
go.
I will only see it growing as we speak. So 5 years, 10
Right.
years, the private secondaries will be far more than what we see today.
Right.
Totally.
I think
100%.
that's a tool a lot of the lobby groups are using to try to lobby with Congress. The market's changed, the dynamics have changed. We can still pursue a venture strategy within this exemption. You should reconsider some of these limits, and it will be interesting to see where that goes as well, because I know there's some active groups in that
Sure.
space.
I think we've already answered it, really, like among the three of us. There's not really more to it. Do you want to be able to pursue something like more secondaries, right? Which you just can't do and keep the
That's a
VC
strategic
exemption.
shift, is what you're saying.
It's a shift. Yeah, it's a shift in strategy, or it's a broadening of the strategy, right?
Understood.
Whereas I
Right.
used to be just buying directly newly issued securities by the portfolio company. Now I want to get access to the secondary securities that are already held by the company. I could no, again, you can keep your exemption. You can try to have your cake and eat it too, right? You can keep your exemption and buy secondaries, but just keep the secondaries less than 20% or not more than 20% of any single vehicle. That's
So
totally fine.
if a portfolio company of mine goes public, does that count, that public security count in my 20%, or it does not?
No.
That will not in that scenario. No. Yeah.
Yeah. It's at the time that you're making the investment. So that comes up. People ask us that also. Like had a great, my unicorn went public and now I have public. That's fine. That's grandfathered in. What other types? Like sometimes VCs for relationship access reasons, they'll invest something in someone else's fund, right? Or they'll invest in a company through someone else's SPV. Those are all lumped in to the same 20% bucket. So your venture fund's direct secondary purchase of securities from the founder of a company, from an executive of a company, together with your fund's investment in another fund, together with your fund's investment in a company through someone else's SPV, together with any public securities your fund may purchase, so that's not very common. All of those things aggregate and they all count towards a 20%. It's not like you have 20% bucket for secondaries, 20%
Right.
bucket for public securities. That would eat up the whole fund, right? It's 20% in aggregate for all investments that are not direct investments in newly issued securities from private companies.
And this is across my AUM, just to clarify. It's not just one fund, it's across my AUM.
No, this is where it's problematic. It's measured at each vehicle. So Jessica can have a client that has 10 $100 million VC funds, okay? And they're all direct securities, right? They all satisfy all the 5 prongs that we talked about. None of those 10 funds has more than 20% of its capital invested in secondaries or public or SPVs or someone else's fund. And it's great.
Mm-hmm.
Then this firm raises $100,000, okay? It's got $1 billion of AUM across 10 funds, all good. They raise $100,000 SPV to buy out a founder of a portfolio company. That whole $100 goes to that secondary. Or I'll even make it worse. $100,000 SPV to buy out a founder of a portfolio company, buy some of shares of a portfolio company founder, and 21,000 of that, right? More than 20% of that $100,000 vehicle is a secondary. You know what you've just done to your firm? Your $1 billion firm, because of this measly $21,000 investment that's a secondary out of this tiny $100,000 vehicle, you've blown your exemption for your $1 billion firm. It's crazy, right? That's why Jessica's saying that's nuts. SEC got it wrong. You're still a venture firm. What, because you have one vehicle that did a secondary, you're not a venture firm anymore? Of course you are. That will take lobbyists to fix.
Yeah, so we all this while we've been speaking about the exempt versus the compliances overhead that comes for an RIA, right? So let's hear a little on that part. What is that extra compliance burden slash overhead that I need to bear if I choose or forcefully have to be an RIA, and what's the cost associated?
I break it down into 2 buckets, and Jessica could elaborate. I would break it down into the pain and the cost of actually going through the registration process, which is a process. And then there's the pain and cost of living the rest of your fund's life, the rest of your firm's life as a registered advisor. There's 2 different aspects of the pain. When I was a young lawyer, when was this? It was like, what was it, like 2010, was it? When the rules were changed and you don't have these exempt, there used to be a different exemption. If you had fewer than 15 funds, then you had an exemption from registering as an investment advisor. And then the SEC got rid of that and put in this whole new framework that we've been talking about until now. So at that point, all of our venture clients and private clients, by the way, PE clients that had fewer than 15 funds, you have to be a pretty big firm to have more than 15 funds, right? So most of our clients had an exemption just by virtue of the number of funds that they had. When that was done away with, all of a sudden, all the lawyers in America who work with funds were scrambling to learn what the Advisors Act was and how to register their clients. So I remember registering all these clients back in the day. It was a pain. You're putting together, I'm sorry, Jessica, to say this. Please push back if you think this is great. You're hiring a chief or appointing a chief compliance officer to run a compliance program at your firm. And Rakesh, you may be 4 guys in a room, right? This is your firm, right? But you have a chief compliance officer, you have a compliance Bible, a set of compliance policies and procedures that you need to design, implement, test, and then there's cost of it. There's a form ADV that you got to fill out, tell the SEC all about it. Open your kimono, tell everything about yourself, publicly available, and then you're subject to examination. And SEC comes in and they examine you. And they could sit in your office for 3 days examining all your books and records, all your PPMs, all your expense statements. So I'm sorry to jump in on this one. This is close to my heart because I felt like I was like, uh, you know, uh, purified in the crucible of the fire, right? When we were registering all these clients.
I hear the pain in that whole statement, believe me. And imagine those who have to go through that. So
Totally. And it's expensive. It's expensive. And the thing is, by the way, it's a lot less expensive when Jessica does it than a lot of others. But I'm just saying when you have the process down, right? You have economies of scale and processes that keep things manageable. But it's not inexpensive no matter how you do it. I would also say this, and Jessica, I suspect you'll agree with this. The rules about the investment advisors, they were really designed ironically, for hedge funds. A lot of
yeah,
them were really designed to protect investors who were investing in businesses and investment funds that are investing in public securities. So even though the rules are now, since 2010 or so, they apply so much more to our world, to private funds, VCs, PE firms, much of the rules that you're going to live with as an RIA, think of the analogy of a square peg into a round hole. It doesn't really fit. So I'll give you an example. As a registered investment advisor, your chief compliance officer is going to keep tabs on, I'm going to mangle this a little bit, but I'll get it right generally, and Jessica could correct me. They basically have to keep tabs on all of the personal trading that your covered employees do. So everyone in your firm who has anything with the investments of the funds, maybe not just a purely clerical person who doesn't have access to the fund's secret sauce, but basically anyone who's active in the fund's management, they have to either get permission from your chief compliance officer or at least notify your chief compliance officer on a periodic basis of how they're investing their own money in public securities and in private securities, I believe, Jessica. So it's like, wait a second, why? Why? Because I'm going to manipulate the market? Because no, I'm just investing in a few startups. How is my public investing sort of creating a risk for the investors in my private investment fund, in my private equity fund or VC fund? And the answer is it doesn't. But these are the rules that, for better or for worse, we have to live with if you're an RIA. Did I say that too strongly, Jessica? Feel free to temper me. I'm a little too
So
passionate
I
on this
think
point.
so. I
yeah.
think so.
So Jessica,
Yoni,
let's hear that part what you were saying earlier, right? Those two parts of the pain to become an RIA and to live like an RIA, there are two different parts of the pain. So pain A, pain B, and the cost associated to be an RIA. And obviously the cost not necessarily has to be numbers, but what it implies, what all I need to have in place, which adds on to my cost.
and it's not as scary as Yoni's making it sound, and you can tailor it, and we can there's technology now. You can link quarterly statements so the employees don't even have to think about it. There's ways to make this less painful than it sounds.
But
And I
let's hear
will
what it
say,
is.
yeah. So I guess, well, one thing we haven't necessarily touched on, and this goes hand in hand for both ERAs and RIAs that we've talked about, there's something called a Form ADV. So this is that registration or notice filing process. Both exempt advisors and registered advisors use the same form. ERAs file an abbreviated version, and it's what's called a notice filing. So you complete a few portions of it, you submit it to the SEC, it is publicly available, you do it once a year, and that's your notice filing claiming the exemption. When you go to register as an investment advisor, you have to complete the entire Form ADV, which includes a narrative brochure. So in addition to the sort of census style questionnaire, you have a brochure describing your business, you have brochure supplements describing your key investment decision makers. It's a lot more time that goes into that, and that's an actual application. The SEC has 45 days to respond. You may have some back and forth with staff, you may not, just depends. And then once you're registered, at the time you become registered or it's accepted, you have to have this compliance program in place that Yoni was talking about. So you need to have your CCO appointed, you need to have your sort of tailored program. You're now subject to compliance with the entire Advisors Act. As an ERA, you're still subject to portions of the Advisors Act. I think that's helpful to clarify. Just because you're exempt doesn't mean you're just whole stock exempt from the Advisors Act. You're still subject to anti-fraud. There's still pay-to-play rules to think about. There's still anti-money laundering rules to think about. That's sort of a select portion of the Advisors Act. When you register, you're now subject to the whole Advisors Act. There's no exclusions from it. There's a compliance rule that mandates a written policies and procedures that your CCO has to review annually, has to implement trainings. There's the custody rule you have to think about. That's where you're required to have annual audits of your fund financials distributed. There's a marketing rule that you should be thinking about as an ERA or as an exempt advisor because of anti-fraud, but now you're subject to more technical marketing requirements. You have to have a net, you have to have detailed disclosures, you have to have support. Your books and records become much more important. You're subject to a suite of books and records requirements. You can keep your employees on track when it comes to electronic communications, how you're able to record their communications. You may have heard of the enforcement actions around WhatsApp or using other sort of text messaging capabilities where the CCO is not able to maintain those as books and records or to review them as needed. There's also another important one to think about is the restrictions on performance compensation. So as a private fund advisor, you want to take a promote, you want to take your carried interest. There's a general restriction now that you're a registered investment advisor. You're only able to take that performance-based compensation from qualified clients. So now in addition to getting reps from your accredited investors, maybe your qualified purchasers under the Investment Company Act, you're also getting reps for qualified clients, which is a slightly higher threshold than accredited investor. And you have to limit your fund to qualified clients if you now want to accept performance-based compensation. So those are just to
Which
name
is
a
why
few.
you're doing this, yeah.
Just to name a few.
So what
I
I'm
won't put
hearing now
everyone to
is
sleep.
what I'm hearing between all
No, you're
these
going to
is
scare them awake.
I'm not trying to. It's really not that bad.
actually I was coming to that. She said that it's not as scary as Yoni makes it sound, but
Yeah.
what I heard probably scares me more. But then, if I have to summarize, I see 3 or 4 important things there. One, everything goes on records.
Yeah.
You have far more filings and reportings than you ever had. You are more subject to scrutinies and disclosures that can be opened up at any point of time. And then everything that you have to do this, you have an associated cost to manage all these pieces.
Right. And while there's technology and service providers available, they all admittedly come with
They all
a
come at a
cost.
cost. Yeah.
Mhm.
And then obviously you spoke about the compensation, the limitations
Mhm.
around how you can have that performance-based compensation and so on.
Mhm.
Interesting.
One thing
Can
to
I add-
keep in mind, I just want to add, so when you're thinking about whether or not to register and how burdensome a lot of this can be, and you're thinking about expanding your investment activities, as your firm grows and you're targeting more institutional investors, it is possible that they will start to ask about your internal compliance policies and procedures. They may want to see written policies and procedures or certain compliance, even though you may not be technically required to do it. Your investors may drive some of that decision.
Like Jessica just said, I'm like Mr. like negative about registration. But there is a positive, right? Not only would it free your venture firm to do secondaries and things like that you couldn't do much of if you maintained your exemption, but like Jessica says, as your firm is growing and you're reaching out and appealing to bigger, more institutional investors and their gatekeepers, there is only a positive in being able to say, we are registered. The
So
SEC
you
vets
invite
us.
more confidence there.
Exactly right. Yeah.
Yeah,
So
I
there
understand.
is that silver lining.
So in summary, to all that we discussed in last whatever time, is that where we started. So just trying to connect the dot from the point we started, that RIA is not a replacement of venture. It's a strategic shift which is adopted when there is a necessary strategic shift to the approach of investing.
Exactly right. Within the realm of venture. Yes, that's right.
Okay. So yeah, I think that kind of brings a lot of clarity to what we wanted to communicate to our audience today. Appreciate you bringing all those thoughts, Jessica. Your points were very helpful. Yoni, you were great as always, and I know that uh, all this will be very helpful to our audience and listeners.
Thank you so much for having us. It was a lot of fun. Thank you.
It's a pleasure.
Definitely. Thank you.